Hello guys, welcome to Bhavna's Online Academy. So in this video, we are going to learn about IND AS2. We are going to cover all the concepts related to this particular IND AS so that you are able to solve the sums easily in the examination. So I'm going to make two parts of this video. The first part is going to have the concepts and the second part will have a few sums in which the difficulty level is quite higher, which are important that you see them before the exam. So that's how the video split is going to be. So this is the first video in which we are going to discuss all the concepts. So without any further ado, let's begin with the video. So let's start with IND AS2. So in IND AS2, what are we going to learn about? So as you all know, as the name title itself suggests, we are going to learn about inventory and its accounting. Okay. So what is inventory? We need to learn the basic of it before we get into the standard, right? So inventory means an asset. As you all know, you have put it into your balance sheet too. It comes on the asset side of the balance sheet, right? So it's an asset, but what kind of assets are included in this inventory is what we have to learn now. So there are three forms which are included in inventory, which is one is finished goods, work in progress and raw material. Okay, suppose if you have to manufacture something, before manufacturing it you need the raw materials, you need the basic items. Even if you have to make up a cake, you need the basic ingredients for it to form into a cake. So the basic ingredients like the maida or the essence and all of them, the raw materials, what we call them as, they will be included in inventory. The second is the cake when it is half baked also. Okay, when it is even in work in progress also, that also will be included in your inventory. And definitely once a cake is made completely and when it is ready to sell, that will also be included in your inventory. So all the three forms, your raw material, your work in progress and your finished goods, all the three forms will be included in your inventory, right? Talking specifically about finished goods. Okay, so here finished goods does not only mean the items which you have produced in your entity, okay, or produced in your company. It also includes goods which you have purchased and you have held it for resale. Suppose you are not a manufacturer but a trader. Okay, so what you do, you buy saris, you stock it in your store and then you sell back again. Okay, so when you're going to buy saris and sell back again, this is known as held for resale. You have got it from somewhere and then you're going to resale it, correct? So those saris which have held for resale also will also be known as your inventory only. So it is not only the manufactured good but also the goods which have been purchased and are going to be sold afterwards, right? Okay, so that's what inventory is about. Okay, so now how do you measure this inventory? At what value are you going to write this inventory in your balance sheet is the question here. Okay, so when we talk about the measurement portion, here you have to see the lower of either cost or net realizable value. Okay, suppose the cost of making the cake was 100 rupees. Okay, but the value at which you are going to sell the cake outside is going to be 500 rupees. So when you record it in your books, you have to record it at lower of cost or net realizable value. So what is less here? The cost is lesser here. So you will record it in your book as inventory 100 rupees. Okay, so you will record it at whatever is lower. Okay, so now after this you have to also remember that when a company is producing multiple items, multiple kind of items. Okay, now when you see Nestle company, they have a range of items that they provide. They have chocolates, they have Maggi and all of that. But will everything be recorded as a whole? Like in the sense, if there is Maggi, okay, and the cost of Maggi is 10 rupees and the net realizable value is 15 rupees. Then you have suppose some Nestle chocolate, okay, and the cost of the Nestle chocolate is 5 rupees and the net realizable value is suppose 10 rupees. Here when you are going to do this, you cannot do total of Maggi and Nestle cost is 15 rupees. Total of net realizable value of Maggi and Nestle is 25 rupees. So 15 or 25, whichever is lower. You cannot do it on a group basis. You have to always value inventory on item by item basis. First take up Maggi and see which is cost or NRV, whichever is lower. Then take up the chocolate, see cost or NRV, whichever is lower. So you have to go item by item basis. Okay, so that is what measurement talks about. So in this, when we are speaking of measurement, we understood that we have to take lower of cost or NRV. Now how do you find out the cost? How do you find out the NRV is a question here. What does cost consist of? What does net realizable value consist of is a question. Correct. How do you value a cake at 100 or 150? Okay, so here we are going to learn how do we come or arrive at the cost and how do we arrive at the net realizable value. Okay, So first let's understand how do we arrive at the cost. Okay, so like I told you in the start, inventory has three forms. Okay, what were the three forms? Finished goods, WIP, that is work in progress, and then you have your raw material. Here we are not talking of raw material. Raw material we will discuss it later. Currently we are only talking about how do you find out the cost of finished goods and WIP. How do you find out the cost of finished goods and WIP? Okay. So first what you do is there are three kinds of cost. There are how many kinds of cost? Three kinds of cost which will get included to form the part of the total cost. One is purchase cost, then you have conversion cost, and you have other costs. So when you add all of these three costs together, you will arrive at the total value of inventory. You will arrive at what? The total value of inventory. So now let's see about these three costs in detail. Starting with the purchase cost. Starting with what? The purchase cost. Okay, suppose now what you are doing is you are having a business where you purchase a mobile phone. Suppose you purchase an iPhone and then you sell it outside. Okay. So now when you're talking about an iPhone, so what will be the purchase cost to the company? What will be the purchase cost to the company? Suppose they have purchased the iPhone to sell it at, suppose they have purchased the iPhone at 20,000. Okay, let's say. I know the price is at a higher range, but for here, let's just take it like that. Then this iPhone, they might not have made it in India. They would have got it from outside India. Okay, so the import duties, whatever are there, those taxes will all get included. After that, for bringing them from there to here, in case they would have ordered a bulk quantity, it would have costed them an entire airplane, or they would have costed them an entire ship. So whatever the transport and handling costs were there, that will also get included. And if there is any other cost which you have spent to make that purchase, that will also be included here. Suppose you had an agent in the foreign country who used to be a communicator between you and that supplier, and he helped you getting those iPhones. So that to that agent you would have paid some commission. So such commission will also be included in your purchase cost. Okay, and then finally when you add up all these costs, there are two costs which you are going to reduce. One is either the rebate or the trade discount. Suppose you have purchased bulk iPhone. Suppose you have purchased 1 lakh units of iPhone, okay, and the supplier got impressed by it and he's like, it's okay, since you have made a bulk purchase and I see you purchasing me from the future, I'll give you a 5% discount on your total quantity. I mean because you purchased in so much bulk, I'll give you a 5% discount. Okay, so if like that, if he's going to say, that is also going to get deducted here from the purchase cost, because that's a benefit to you. Okay, so this is what consists of the entire purchase cost. Here one thing that you have to remember is there is one more term which is known as a credit discount. Okay, so in credit discount what happens is that the supplier tells you that in case if he'll give you a credit term of suppose 30 days, that you can pay me within 30 days, but in case if you pay me earlier than 30 days itself, I'll give you a discount. Okay, so here he is not giving you a discount because of the products that you purchase, but because here you have made a payment earlier itself. Okay, so such credit discounts which is related to payment, it will not be included in the purchase cost of iPhone. Okay, I hope you understood what purchase cost is. Next, talking about the conversion cost. Next, talking about what? Conversion cost. Suppose this conversion cost gets applied only and only when you are making something in your firm. Okay, you are manufacturing it. Okay, from raw material to finished goods, you are making by yourself. Okay, suppose let's take the example of the cake. Okay, so what are the conversion costs that will get included? When you transform the raw material into a finished goods, there will be a few costs that you have incurred. So those costs and all will get included here. The first starting with is your direct material. Like I told you, the essence, the maida, and some other flour which will be needed. Suppose all that will get included here in the direct material cost, because you need all of them to make the cake. Next is the direct labor cost. So a few people you would have kept in your bakers or chefs you would have kept there, so that they could make the cake and give it for you. So that direct labor cost will also get included here, which is directly involved in making the cake. Then any other direct cost if you have included, suppose to run any baking machine or an oven. Suppose you have incurred electricity charge. Okay, that electricity charge was required to make the cake. So some direct cost like that will also get included as a part of your conversion cost. So direct material, direct labor, and other direct costs, all these three costs which are directly related to the making of the cake will get included as your conversion cost. Okay, Now talking specifically about a few overheads. Okay, so as you all know, overheads are other costs. Okay, so here overheads can be of two types. One is variable cost and the other one is fixed cost. So as you all know, what is variable cost? Variable cost is the cost which will get increased or decreased, or which will get affected depending on the number of units of production. Okay, whereas what is fixed cost? It is fixed. No matter how much units you produce or you don't produce, it will not get affected. It will remain the same. It will remain the constant. Correct? Yes. So now specifically variable overheads, it is very easy to measure. Okay, for one product how much it would have been, because depending on the number of units of production only it will get incurred. Okay, right? So that's not an issue. But when talking about fixed overheads specifically, what happens? So here you are not very sure how many units you would produce every year. You can either produce lesser or you can either produce higher. Okay, so depending on your efficiency, you do that. So here what happens in fixed overhead is that since you do not know in which year how much you are going to produce, so fixing a per unit cost will be difficult here. Okay, so how do you find out this per unit cost? It is what we are going to learn now. Okay, so what is going to be a per unit cost? So what happens usually in the firm is, suppose I am a baker. Okay, I have a baking company where I make a lot of cakes and sell. So usually normal capacity in my cake shop is that let's just imagine that the demand is always there for the cake. Okay, let's assume that the demand is always there, and you only just have to supply. Suppose you in a year you are able to produce 500 cakes. In a year you are able to produce how much? 500 cakes. Okay, that will be called your normal capacity. That if you're normally working with everything going on the standard pace, then you will be able to produce how much? What's your normal capacity? 500 cakes, right? Now what is actual quantity? How much you're able to actually produce? In the exam, you normally in your mock test were scoring 80, 70, 85, somewhere in that range. But when you are going to actually give your CA examination is when you will know what marks you get. If you get 40 marks, that will be your actual marks. Normally you score this much, but actually in that particular year, depending on all the external circumstances and internal circumstances, how much have you produced? Suppose this year we have only produced 400 cakes. You can also produce it lower and it can also be higher. It's not that you will only produce it lower. You can also produce 600 cakes. Correct? Okay, so let's take these two cases. Okay, let's take 1 minute. Yes, let's take this two cases. Now talking about the first case where your actual quantity is more than your normal quantity. You thought that normally you can only produce 500 cakes, but something so efficient happened that you were able to produce how much? 600 cakes. Here what happens? Your fixed overhead gets split up in even more bigger quantity. So your fixed overhead cost will be lesser. So the cost of your product will go down, correct? So here how do you find out your per unit cost? Here you have to find out fixed overhead divided by actual quantity. So whatever suppose the fixed overhead is 1 lakh rupees, so you do 1 lakh divided by the actual quantity that you have produced, that is 600 cakes. Okay, so this is how you will find out your per unit fixed overhead. Okay, now let's take the second case. Let's talk about what? The second case. So in second case, what you do, you have your normal capacity which is higher than your actual capacity. Your normal capacity is how much? 500 cakes. Yes, so your normal capacity is 500 cakes, where what you have actually produced is just 400 cakes. You have produced it lower than that. Okay, so here how do you find out your per unit cost is that you will divide it by your normal capacity. So fixed overhead divided by normal capacity. So here there is one thumb rule. So there is one thumb rule that you have to remember. What it is, divide your fixed overhead by whichever is higher. If your actual quantity is higher, divide the fixed overhead by your actual quantity and find out the per unit cost. If your normal capacity is higher, then divide it by the normal capacity and find out the per unit cost. So whichever is higher, divide it by that and find out your find out your per unit cost of fixed overhead. Okay, I hope you understood that. I hope you understood this. Any doubts? Any doubts here? Okay, yes. So I hope everybody would have understood until now. Now talking about one part that you have to notice here, when your normal capacity is higher than your actual capacity, is that here you were inefficient. Here what happened? You were inefficient. That's why even at the normal capacity you were not able to produce it. Normally you could easily produce 500 cakes, but there was something abnormal that happened where you became inefficient and you were only able to produce how much? 400 cakes, right? Okay, so here what you do is, so here this is like a loss to you. This is like what? A loss to you, correct? Because you could have produced 500 but you were only able to produce 400. So what you do here, you book that loss in your P&L account. You book that loss in your P&L account. How do you find out that loss? Is the formula here. So what you do, you take your total fixed overhead. What was your total fixed overhead? Your total fixed overhead was 1 lakh rupees. Okay, and you do minus actual quantity. What was your actual quantity here? Your actual quantity was 400 multiplied by your fixed overhead rate. What was your fixed overhead rate? You have to understand here. What was your fixed overhead? Here fixed overhead is nothing but the per unit rate that you found out. What was the per unit rate? It was 1 lakh divided by normal quantity, which was 500. So if you do this, you will be able to arrive at the loss. You will be able to arrive at your loss. Okay, so here what will be the loss? Let's just find out quickly. So it will be 1 lakh minus 400 into 200, which is nothing but 1 lakh minus 80,000, which is your 20,000 rupees. So here 20,000 is your loss, which you will have to book at your P&L amount, which you have to book in your P&L account. Okay. So here what you do is, so now you have understood what is your P&L account. So when you are accounting it in your books, so what happens when you are accounting it in your books? How do you account it? As you take your P&L account and then you have your balance sheet, right? So in your P&L account you will book your loss. You will book your loss 20,000, and in your balance sheet you have to account that fixed rate into your inventory rate. So what amount will you account here is your per unit rate that you have found out multiplied by the number of units. Okay, yes. So this is what you are going to account it here. And how are you going to find out the per unit rate? Per unit rate, just now I told you, whichever is higher, divided by that and find out your per unit rate, and that's how you will come up with your fixed overhead. Okay, yes, I hope you understood this concept. Okay, is there any doubts? I hope there is nothing. Okay, yes, so now let's move on to the next topic. So we just now understood, where did we start? We were lower of cost or NRV. We have completely understood about cost now. Now we are going to understand the next concept, which is about NRV. How do you find out the net realizable value? Okay, so starting with your net realizable value, there are 3 items which are included in your net realizable value. First is the estimated selling price. At what price will you be able to sell the cakes at? You will be able to sell the cake at suppose 500 rupees. Okay, so that will be your estimated selling price. Now to complete that, to bring that raw material into your finished goods, you would have incurred some expenses. Which will be known as your conversion expenses, which will be called as your conversion cost or your conversion expenses, correct? So if the cost of completing one cake was 100 rupees, to bring that raw material to a finished good, suppose if you have put in a cost of 100 rupees, that 100 rupees you will minus from your selling price, because selling price is an income. Okay, and 100 rupees you have put in a cost to bring in that income. So you will take the net income only. So 500 minus 100, and then any cost that you have made to make the sale. Okay, so cost to make a sale, example could be that you have suppose you have a person who you have employed, okay, someone like an agent or someone who will get orders and give it to you for cakes. Okay, so to that agent you are paying some commission or something that you sell cakes. Okay, for every cake you sell, suppose you are paying 1% to him or her. Okay, so that 1% will be your cost to make the sale. So minus that 1% you will do. So that will become your net realizable value. Okay, yes, so this cost of completion will not come in the case if you are making a resale. If you are buying something and then selling it directly as a finished good itself, then in such case there will be no conversion cost or cost of completion. Okay, always remember that. Now talking specifically about the selling price, here there might be two kinds of selling price. There might be two kinds of selling price. One is your contract selling price and the other one is general selling price. Okay, so you could have made a contract with the party. Suppose you could have taken a birthday order, a big birthday order or a birthday contract, where you would have told that you would sell your cake at 400 rupees each. 400 rupees each. So your selling price here will be 400 only. Or else at regular, now whenever there is a regular customer, okay, and they only order for one cake or two cakes and they're not ordering in bulk, you usually charge them 500 rupees. So if it is a general selling price, take that itself. Okay, if you're generally selling it, take 500 rupees only. But if there is any contract where you have agreed to sell at a particular price, take that contract selling price. Okay, yes. So that is about your net realizable value. So I hope you understood the first chart. I'll just go through all of it once again and I'll give you a quick summary. First, we understood about what is inventory, how do you measure it, lower at cost or NRV, what are the components of cost, purchase cost, conversion cost and other costs. In other costs, we understood how do you value fixed overheads, and then we finally understood about net realizable value. Yes, I hope there are no doubts until this. Okay. Now moving on to the second chart. Okay, moving on to the second chart. Here we talk about a few more points related to cost. Okay, so here there are few more points which we need to discuss. First of it is talking of deferred settlement. First talks about your deferred settlement. Deferred settlement means you are making a settlement beyond the normal credit terms. You are making a settlement beyond the normal credit terms. Okay, suppose a normal credit term is that you usually the normal credit term is of 1 month. Okay, but what happens, since you are not able to make the payment within 1 month itself, suppose if you would have to make a payment within 1 month itself, you would pay 10,000 rupees. Now since you are making the payment after 6 months, you have to pay 60,000 rupees. Okay, just say for instance. Okay, so here there is a price gap, correct? Since you are paying beyond the normal credit term, there is something extra that you are paying. What is that extra payment that you are doing? It is the interest that you are giving them. It is the interest that you are giving them. Okay, because there is a value, okay, of money which gets reduced over time. So I would have understood the time value of money. So because of that, if you are giving someone a beyond credit term, payment, they will charge some kind of a hidden interest in it. Okay, so that is what is known as your deferred settlement, where you pay beyond your credit term. So here, how do you find out the interest part is the question. How do you find out that? You take whatever the actual amount you paid. Actual amount you paid was 60,000 minus cash price equivalent. Cash price equivalent means how much money you would have paid if you would have paid it today or within the normal credit terms. Now because you are paying it after the normal credit term, you are paying 60,000. But in case if you would have paid within the credit term itself or today itself, how much would you have paid? 10,000. So 60,000 minus 10,000. So here 50,000 is the difference, which will be your interest. Okay, that this wouldn't be such a huge gap. This is just for example, okay, that I have taken here. Okay, I hope you understood what is this. Now talking about the next part. So here when we talk about outcomes of a product, okay, so here when you have an outcome of more than one product, you do some production process, and in this production process, when the production process is over, you don't only get one product outside it, but you also get another product. That is more than one product you are producing in one production process itself. So here there might be two cases. One, you will be able to produce either a joint product, or that means joint product means both the products have equal importance. Okay, where other case might be you are producing one main product and the other outcome is a byproduct. In the first case, you have two outcomes, but both outcomes will be termed as joint products because both of them have equal materiality and equal significance. Whereas in the second case might be that you have two outcomes, but one is very material and significant, which will be known as your main product, and the other one will be just a byproduct. Okay, now first let's talk about how will you do accounting for a joint product. You have to see, so as you all know, what happens in the production process, there is raw material, then it gets converted into finished goods. Okay, so when it gets converted into finished goods, you don't get just a single finished goods, but here you get two finished goods, suppose A and B, and both are joint products which are equal materiality and equal significance. So here, how do you find out, the cost, conversion cost? Now suppose you have made a conversion cost of suppose 20,000 rupees. Suppose you have made a conversion cost here of 20,000 rupees. Okay, So 20,000 rupees, how are you going to split it into both the products is the question here. Suppose if the 20,000 rupees is easily identifiable, that on A you spend this much only, on B that you spend this much only, then directly separate the cost. If the conversion cost can be easily separated, separate the cost and account it. Okay, but the problem arises when you're not able to separate this cost. You don't know how much the conversion cost would have been spent on A and how much the conversion cost would have been spent on B. So here what you do is you take a ratio. You allocate the conversion cost based on the sale value. Based on what? The sale value. What sale value? Here you have two options. One, you can take the sale value at the point of split. That means there will be one point where it got split into A and B. At that point itself, if you were to sell A and B separately, how much at what value you would have sold? Suppose I could have sold A at 10 rupees and I could have sold B at 20 rupees. Then in such case, at the point of split, if that was the case, then you would split the 20,000 into 10:20 ratio. That is 1:2 ratio. Okay. That is the first preference always. You have to always prefer the sale value at the point of split and take that ratio and split your conversion cost. But now if that is not possible, then once the entire product is completed, here after after the product has been split into two, you can still, the product might not be ready. You might have to still do some further processing cost. Suppose on A you do a further processing cost of 5 rupees and on B you do a further processing cost of 10 rupees. After both the products are completely done, your A value is at 15 rupees and your B is valued. That means your cost is 30 rupees. After completing the A and B completely, after incurring your further processing cost and all, after that whatever is the sale value, you can take that ratio and split your conversion cost into that. So I hope now I am clear. When conversion cost can't be separated, take the sale value and split it. But at that ratio, you can allocate it. What will be the sale value? First preference, give to the sale value that you will be able to sell when you have at the point of split itself. At the first split itself, at what point you will be able to sell or at what value you will be able to sell. If you are not able to find out the sale value at the point of split, then take the sale value post completion after you have incurred all the further processing costs and the total product is completely ready. Okay, that's about joint product. I hope there's no doubts. In case if there is anything, you can ask in the chat box. Now talking about the second one, main product and byproduct. Here what you do is, you see whether the byproduct that you have produced is immaterial or whether it is material. Whether it is material or immaterial in terms of cost. Okay. So if it is immaterial, what you do is, you take the conversion cost of main product. Suppose the conversion cost of main product was 15,000 rupees. Okay, and suppose the conversion cost, total conversion cost itself was 15,000 rupees. Not only related to main product, but the total conversion cost was 15,000 only. Okay, in that what you do, whatever the net realizable value you will get when you sell the byproduct, deduct it from that. Okay, suppose to bring the raw material to finished goods, I did a conversion cost of 15,000 rupees. After doing that 15,000 rupees, I got two products, A and A1. A is my main product, A1 is my byproduct. Now, how do I split this conversion cost between both? Here there is one doubt. Okay, so here what they tell you is, don't consider A1 as a product itself. Okay, just consider it as a scrap. And what you can do is, you can charge the entire 15,000 or the entire conversion cost on the main product itself. But there is one condition. Before you charge the entire conversion cost to the main product itself, you can reduce the scrap value or the byproduct value. Byproduct selling price. Suppose you could have sold the byproduct at suppose 2,000 rupees. So do 15,000 minus 2,000 and the remaining 13,000, that cost you can completely charge as conversion cost of the main product itself, that is to A itself. Okay. Yes, I hope you understood. But if the byproduct is material, what do? You treat it just like a joint product and just do whatever I said in the joint product. Okay, so here both the products are material. So just use it as a joint product accounting. Use that accounting itself and account for it. Okay, I hope this is also clear to you. Next, talking about raw material valuation. So when I was talking about cost itself, I told you that there I will not speak about raw material. There I only told you how you have to find the cost of finished goods or WIP. Here we are going to talk and understand how are we going to find out the cost or NRV of raw material. Okay, so always remember, raw material does not have a net realizable value. So here raw material does not have a net realizable value because the raw material that you're going to purchase is not for selling, but it is rather is going to be used into a production process and it will give you a finished goods. Okay, so you don't have any realizable value for it as such. So here you only incur a cost on raw material. Now you have to see on your finished goods. So what do you use this raw material for? To produce your finished goods. Okay, so when you are producing your finished goods, after the production of finished goods is over, when you try to sell the finished goods, you have to see whether the selling price of the finished good is either greater than or equal to cost. This is the usual case. If I am producing a cake at 100 rupees, I would want it to sell at 500 rupees or at least a minimum of 100 rupees or 200, 300, 400 or 500, more than or equal to cost. At least I should be able to recover my cost or make a profit on it. This is a normal case. If it's a normal case, then account your raw material or value your raw material at cost itself, at your cost itself. Okay. Now suppose we talk about the second case where your finished goods, here the selling price is less than your cost. That means if I am making my cake at 100 rupees, people are not even ready to buy it at 100. They want to buy my cake for 50, 40, 30 only. My cake has become worthless now. So here what happens? Here your raw material. So here as the time goes on, what will you think? That you want to close down this business. Correct. So here what will happen is, you might, whatever raw material is left in your business, you will want to sell it. When you would want to sell this raw material outside, you will want to, suppose you want to start another new business. Okay, so what you will do? You will sell out your, earlier raw material, whatever you had, old raw material, whatever you had, you would want to sell it out and replace it with new raw material and start up a new business. So the replacement cost that will be incurred. So to replace this raw material, there will be some replacement price. No, then outside there will be one person who will be able to ready to take at that price. So you have to measure lower of cost or replacement price. Lower of what? Cost or replacement price you have to take. So whatever is lower, you will take that and account it as your raw material value. You will take that and account it as a raw material value. Usually it will be the replacement price, because if you have bought your raw material at 100, today if it is worthless, anybody who is outside will only take your raw material at a 50 or 40 now. Usually the replacement price will only be lower, but in case if in the market they are giving you a replacement price of 110, still you cannot account it at 110. You will have to only record it at whatever is lower, that is 100 only, because you have only spent 100. You cannot record more than that in your books, then it will increase your assets, right? So you cannot do that. So lower of either cost or replacement price of the raw material, you can account the raw material at that value. Hope you understood this. Okay? Yes. Now talking about the next part. So we have completed all the points which is related to cost. Now talking about the other points, which is your net realizable value. Related to net realizable value, there are a few more points that I want to discuss. Okay. First, starting with the subsequent assessment. Here what happens, every year end you are going to assess at what value is your inventory going to be valued. Okay, suppose what happened in the first year, the cost of the inventory was 100 rupees and your net realizable value was 80 rupees. So what you would do? Cost or NRV, whichever is lower. So you accounted your inventory at suppose 80 rupees itself. Now the second year came. In the second year, your net realizable value went up to, suppose it went up to 90 rupees. Okay, and what was your cost? What was your original cost? 100 rupees. So here you will do cost or net realizable value, whichever is lower. So today you have to account this net realizable value at 90 rupees. You have to account this net realizable value at 90 rupees. So here what you will do? In the previous year you would have made a write down. You would have made a write down or a write-off of 20 rupees from inventory. You would have made a write-down or write-off of 20 rupees from the inventory. This year, the inventory value has gone up to 90. So, here what you have to do is, you have to do the reversal of write-down. From last year, how much can you reverse this year? You have to account it at 90 rupees. Answer me, how much are you going to reverse this year? You are going to reverse 10 rupees this year. Okay, so you have to do in the next year, you do a reversal of write-off and you bring it up to 90 again. So in a subsequent assessment, if in the previous year you have written down the value of inventory, but in the current year if there is any increase in the value of inventory, then whatever you have written down last year, first you have to reverse this. Whatever you have written down last year, first reverse it. Okay. And then if there is anything else, you can account for. Correct. So here how much can you maximum reverse? What is the value that you can maximum reverse here is how much you have originally written down, that only you can reverse. Here if I have written down 20 rupees from my inventory, you can only again do a reversal of 20 rupees only, not more than that. So that is the maximum reversal here. So that is about your subsequent assessment. Okay, yes. Now talking about the second point related to inventory, it talks about your IND AS 37, which talks about provision and contingencies. So here suppose just imagine that you have a firm and you have contracted that you will provide suppose 1000 cakes to them. You have told them, you have made a contract that you will give them 1000, suppose let's not take cakes, let's say toys. 1000 toys you're going to give to a company. Okay, that is your contracted quantity. But right now at your production place, you only have a toys of suppose 250 toys. You only have 250 toys, but here how much have you contracted? 1000 toys. So here there is always a contingency whether you will be able to produce 1000 toys and give them or not. Correct? Because right now the actual available quantity is only 250. So due to this, you need to make a contingent liability that whether you will be able to produce it or not. So make a contingent liability related to this. That's what they are talking about here. Okay. Next, there is one more point which is related to write down. That means writing down of inventory. This is a different point. Here the reason of this write down is going to be because of IND AS 8. So IND AS 8 talks about events after balance sheet date. Events after balance sheet date. So what happens is that you have 31st March has gone by and your FS is going to get signed at 15th April. Between this 31st March and 15th April, there are 15 days. In this 15 days, there is some event that has happened due to which on 31st March, if your inventory value was 100, it has gone down by 80. It has gone down to 80. Okay, so 20 rupees here there is a decrease in the value of inventory, and that is an event which has occurred after the balance sheet date but before your signing of financial statements. You have to see whether there was a condition which was existing on the balance sheet date itself. So here you have to see whether on the balance sheet date, whether there was any condition which reflected that in this upcoming 15 days your value could go down. If there was any condition on the balance sheet date itself due to which after the balance sheet date but before your signing of financials the value went down, then in such case you can account for this and you can reduce your value. You can write down your value accordingly. So from 100 to 80 you can bring it and 20 you can write down. If the condition was not existing on your balance sheet date or before that, then you need not write it down. Okay, yes. So I hope you understood the other points related to net realizable value. And the final topic of IND AS 2, here we are and we are going to talk about the inventory valuation. Now talking about inventory valuation, here we are going to understand by what method are you going to value your inventory. Okay. So there might be two types of inventory. One is your interchangeable inventory and the other is non-interchangeable inventory. And the other one is what? Non-interchangeable inventory. So what is interchangeable inventory? That you can change the inventory anyway, but everything at the end of the day is going to look same. Suppose if you have 10 Maggi packets, here what will happen? Even if you interchange them, keep it here, and there, it's still going to be same and you will not notice a difference anything in that. So that is interchangeable inventory. What is non-interchangeable inventory is when you have something custom made. Suppose cakes. So one person you will prepare one thing, in one custom, suppose in one cake you have written happy birthday Bhavna, in the other cake you have written happy birthday suppose Ria. Okay, so here you cannot change the cake and give to anyone. They are non-interchangeable. They are custom made. Okay, so now let's talk about how when it is non-interchangeable, you know what is the specific cost of it. You know what is the specific selling price of it. So there is no problem in that. Problem arises when there is interchangeable inventory. So you don't know. Suppose what happened when they were producing Maggi. Suppose in Maggi you use some masala. And maybe a year back you would have bought the masala at 100 rupees. Today the masala price has gone up to 150 rupees. Okay, so you don't know which Maggies you produced using this 100 rupees masala and which Maggies did you produce using this 150 rupees masala. So the cost here you are not able to exactly find out because everything is interchangeable, right? So at such case there arises a question that how do you value it? So in our IND AS there are 4 methods that they spoke of by which we can value our inventory. One is first in first out. That whichever has come in first, that has only been sold out first. Okay, so that is one method. And the second one is weighted average method, where what do you do, how do you find out the cost? So in the first FIFO method, suppose suppose there are 10 Maggi packets, okay, and Maggi packet number 1 got sold today. You would just assume that this Maggi packet number 1 was produced at 100 rupees masala. Suppose using that 100 rupees masala, you produce some 2 packets. Okay, you produced how many packets? 2 packets. Now you will just imagine that if this 1 Maggi packet has been sold today, it was using that 100 rupees masala only. Okay, so even though this Maggi packet might have been produced later on, since you don't know when it was produced, you will just imagine that whichever has gone out first, whichever has been sold first, for that you will apply the earlier cost itself. Okay, so first in, first out. Next is weighted average. So here what you do is you take an average of all the costs and you apply it on the Maggi. So here you will do 100 plus 150 divided by 2, and whatever average cost you're getting, you will apply that on each Maggi packet. That is your weighted average method. Next, you have a retail price or adjusted selling price method. So when do you use this retail or adjusted selling price method is when you have many items which can be interchangeable and which have similar profit margins. When you have similar profit margins, so here what is the formula that you use to find out your cost is that you will have a selling value. Suppose you sell each Maggi packet at 100 rupees and a profit on that every Maggi product, what you get a profit is a profit of suppose 5%. Okay, so here what happens, you will just assume that your cost here, so here you will just assume that your cost here is 95 rupees. Here you will just assume that your cost here is 95 rupees for all the Maggi packets. You are going on the reverse basis. You see here what is the sale value and then you do minus gross margin and then you come at your cost. So this is one method. And the final method is a standard method. Okay. Okay, so when do you use this standard cost method? So what happens usually is that when a company has been there in the industry for a very long period of time, they know that to make a particular product, what would be the standard cost that would have been incurred, correct? Because the materials that they are using or the supplies that they are using or the labor efficiency that they have seen over the years, the capacity utilization that they have seen over the years, all these 4 factors come into play. And when you have a very good idea about this, when you have been into the industry for a very long time, okay, you understand that if the normal level of inventory is being produced, then you can apply the standard cost itself and value it. In case suppose in a year if there is some inefficiency, okay, you review the standard cost every year. Okay, so what happens, depending on the industry and the you keep on changing the standard cost. Here what happens in case suppose in a year in your firm itself or in your company itself, if there is some inefficiency, according to that the cost will be changed and charged to the inventory. Okay, yes, so usually in our exam this FIFO method and weighted average method is what is usually asked, so please concentrate on these 2 methods more. Okay, so I hope you all would have got a understanding on what IND AS 2 talks about, and because I've quickly taken you through each and every concept that is there in the study material. So I hope this video was helpful to you. I'll try to come up with a part 2 where I particularly discuss sums which are a little bit complex in nature and which are important for the examination. So you can, in case if you have any doubt, you can comment that in the comment box below, down in the chat box or the comment box. And also I'll try to link this PDF of this mind map in my description box in the link, or either I'll share it in my Telegram channel. So the link of the Telegram channel will also be provided in the description box below. So yes guys, thank you so much for joining into this session. I hope you all found this helpful. In case if you did, please make sure to like, share and also subscribe to the channel and share it with all your friends who you think will help them. Yes, so see you in the next video guys.